Hello everyone and welcome to the revisionary classes. This is with respect to strategic financial management and this will be for CMA final exam coming soon, that will be conducted in July 2023. So fine, we have planned a series of these sessions for 3 days and I will be open to take your views on what we have to target in the coming 2 days, what I'm going to do today and the next 2 days. As per my plan, I will tell you clearly. What I'm going to do is, today I have decided to take a segment that will be covering bond valuation and equity valuation. That is chapter number 6 as per your revised study material, that will be as per 2022 syllabus. And later in the day we will be covering concepts of portfolio management. And for tomorrow and the day after tomorrow, that will be 7th and 8th of June, what I am planning to do is covering the market based topics like derivatives and forex, which covers the entire risk management concepts. And of course, in short, it will be coverage of derivatives and forex. In 3 days for these revisionary classes, as per my plan, I won't be able to do anything else. If you still want me to specifically cover any issue, any matter, any concept, you can just put forward your comments, and based on the comments given by majority of you, I will reconsider what I have to do in the coming 2 days. So what I would want you all to do is just try to be as much interactive as possible, because this is a live session. Let us take the complete advantage of these live sessions. And what we do, we will be beginning with the topic bond valuation, followed by equity valuation, and a small copy of notes which will contain some examples I have uploaded on my Telegram channel. So I would recommend that you should download a copy of the same right away. I believe you are all there linked with my Telegram channel. If not, quickly search for it and download the notes copy for today's session right away. Please do that and let me know when you are ready with the exactly ready with the copy of the notes, so that I can begin with discussion on bond valuation. So I'm waiting for your responses. You can search for my Telegram channel just in the name of CA NIKHIL JOBANPUTRA and quickly give me your responses whether you got the copy of your notes or not yet. And do one thing, in your notebooks write up this heading, bond valuation. Alright everyone, please give me a confirmation that by now you would have downloaded the copy of the notes, and let us begin with our discussion over here. So what exactly will be our plan? I would recommend that some notes writing and solution writing you may skip initially while attending the class, because the copy of this live stream will be available on my YouTube channel definitely for at least a month's time. So whenever, as per your convenience, you would want to note down something, later on you can revisit the same video, watch it and write down. We would want to maximize the availability of time and the utilization of this available time, and that is why I would suggest you not to spend too much time in writing down. This is more of a discussion and a kind of revisionary class. So you should not kind of lag behind just for sake of writing notes. You should be attending as and when I am taking you ahead. So you have written the topic title as bond valuation. Within bond valuation, the first thing that I would want you to understand is clarification of certain basic terms. See, it is important for you to get those concepts completely clear, so that when we are dealing with questions, when we are dealing with problems, you should be able to figure out how exactly this valuation will be done. Yes, a couple of doubts are coming, as in whether this topic is applicable for 2016 syllabus as well. The answer is yes. What I have picked up for these revisionary classes, these are not topics which are exclusively applicable only for 2022 syllabus. It is applicable for 2016 syllabus as well. So please write up this heading, bond valuation basic terms. See the detailed content of these basic terms. You don't have to write right now. Let us try to understand the basic terms as and when we discuss. We start with face value. Now what happens when it comes to the face value? What is the meaning of face value of the bond? It's basically the nominal value of the bond, the value which is inscribed on the face of the bond, the denomination of bond. Basically, when we say 1000 rupees bond or 100 rupees bond, that is the denomination of the bond. That is the face value of the bond. So a bond may be traded at a value in the market which is different from its face value. For example, a 1000 rupee face value bond might be available in the market at rupees 983. That 983 over there could be considered as a market price of the bond, whereas the face value of the bond will be rupees 1000. Now what is coupon rate? Coupon rate is the interest rate committed by the bond issuer to the bond holder, and this coupon rate is applicable on the face value only. For example, the nominal value or the face value of the bond is rupees 1000, and coupon rate applicable on that bond is 8%. Generally you would find terms like 8% bonds. So 8% bond indicates that 8% is the coupon rate, and it would indicate that annually the bondholder would receive 8% of the face value, that is 8% of rupees 1000 in my example. 8% of 1000 is what? Rupees 80. Rupees 80 will be coupon payment every year. So when I say 8% bonds, it implies that the coupon rate is 8%, and it is also implied that it is an annual interest payment. So that interest payment itself is termed as coupon payments, what I have just mentioned. So I have explained you face value, coupon rate and coupon payments. So coupon payment, if you have to compute, you have to multiply the coupon rate to the face value. Now, what is the issue price of a bond? Now, before I talk about the issue price of the bond, let me explain whether, I don't know whether you have learnt it or not, but when it comes to debt market or stock market, there are two segments of the markets. One is what we call as primary market, one is what we call as secondary market. In the primary market, when we are bifurcating the bonds market or the debt market, where debentures and bonds are traded, so the primary segment or the primary market, which is one segment of the debt market, is the market where the bond issuer will be issuing the bonds to the public. Public will be purchasing the bond or subscribing to these bonds by making a payment to the bond issuer. It's a transaction between the issuer of the bond and the investor. Whereas once a bond is issued, it will be traded in the open market, where various investors will be buying and selling the bond which was already issued. This activity of buying and selling bond happens in the secondary market. So bond issue takes place in the primary market and the trading of that bond happens in secondary market. When I say issue price of a bond, it is basically the price which is quoted in the primary market at the time when the bond is being issued. That is the meaning of issue price. So issue price has nothing to do with the secondary market. Secondary market is concerned with the prevailing market price or the current market price, whereas primary market deals with the issue price. Now, as I told you already, I have explained what is the meaning of market price. The term market price necessarily refers to the price of the bond which is prevailing in the market, and here when I say market, we don't refer to primary market, we definitely refer to the secondary market. It is the market price, means it is the price prevailing in the secondary market where bond is traded among the investors. Now, what is the maturity date of the bond? Maturity date of the bond is basically the date on which the bond is due for its redemption. Bonds generally will be redeemable bonds. So bond is due for its redemption, or if it is a convertible bond where a bond is supposed to be converted into equity shares, the date on which the conversion is to be effected. So it is the maturity date of the bond, that is the date on which the bond will be either redeemed or converted into equity depending upon the nature of the bond. Now, what is redemption price? Price promised by the issuer of the bond to the holder of the bond, that on the redemption date what value will be given in the hands of the holder, that will be the redemption price. So redemption price can also be termed as redeemable value. A bond may be redeemed at par or premium. Par means exactly matching with the face value. Premium means something little more than the par value. Intrinsic value, the most interesting calculation in the entire bond valuation concept, is about the intrinsic value. Intrinsic value is the true value of the bond. It is the value which is the base of the market price. That means market price of the bond is somewhere closely connected to its intrinsic value. The intrinsic value is the fair value of the bond. So when you want to decide whether the bond should be purchased or not, you end up comparing the market price with the intrinsic value. So if it is the comparison between market price and intrinsic value, you find that market price is less, intrinsic value is more, you would find that the bond is underpriced in the market and you would want to subscribe to that bond, you would want to purchase that bond. Inversely, if you find that market price is greater than the intrinsic value, the market price being greater than intrinsic value, we would call that the bond is overpriced in its market or in the secondary market, and in that case you would be better off by selling the bond. So it is throughout the bond's life there is a constant comparison between the quoted market price and the fair value of the bond. The quoted market price is the market price of the bond, and when we talk about the fair value, it is the intrinsic value of the bond. Now, bond strips, a very, very important term where there are allowance given by the issuer of the bond. That means issuer of the bond is issuing the bond in a strip manner. Strip basically over here is an abbreviation. I'll tell you what will be the expanded form of this. So if you can understand, it is STRIPS, strips, that is separate trading of the bond's interest and the principal payment. So separate trading of the bond's interest and principal payment. So when we are dealing with examples, I'll make you much more clear with bond strips. To understand, when you purchase a bond, you get rights on that bond. Two types of rights you get: the right to receive the cash flows on account of coupon payment and the right to receive cash flow on account of the redemption price. Both of these are your rights to receive cash in future. So what happens when it is right to receive cash flow in the future? If it is the right to receive interest payment, it's a separate right. Right to receive the redemption price is a separate right. So an ordinary bond cannot be traded separately, whereas a bond which is a stripped bond can be traded separately. Means you can detach the interest strip and sell it separately, where you can retain the redemption strip, or alternatively, if you want to sell the redemption strip, you can sell it and retain the interest strip. So when the bond is stripped, it will be capable of trading into both segments separately. Next comes is the discussion on callable bonds and puttable bonds. Now, what is the meaning of a callable bond? See, a bond which can be called upon or called back by the issuer for a premature redemption. You know, in derivatives options, we generally call two types of options as call option and put option. Call option is the right to buy, put option is the right to sell. So if a bond is a callable bond, let me give you an example. Suppose I am issuer of the bond and you are holder of the bond. If the bond is callable bond and say the life of the bond is 10 years, but I have placed it as a callable bond and the call date is 5 years from the date of issue. So at end of 5th year from the date of issue, the issuer of the bond, that is myself in this example, will be having right to call back these bonds for a premature redemption. That is what we call as callable bond. So in callable bond, the issuer of the bond has the right to purchase it back at a date prior to the redemption due date or the maturity date, but that date has to be mentioned clearly. That date is what we call as call date, and the price that will be paid to the bond holder if the bond is called upon, that price is called call price. So call date, call price are all related to callable bonds. Now what is the meaning of puttable bonds? It is the word put which comes from the derivatives, which is indicating a put option. A put option is basically right to sell. So if I am issuer of the bond and if I issue the bond as a puttable bond, then I am giving the right to the holder of the bond to sell it back to the issuer before the maturity date. However, the date on which the bond becomes puttable cannot be any date. It has to be a prescribed date. So that particular day, if the bond holder wants to sell it back, that means sell back the bond to the issuer, that is to the company that has issued the bond, it can simply do so. So call date and call price I just explained to you. Now what is the meaning of current yield? See, when it comes to yield of a bond, yield basically represents the rate of return. So how much yield you are getting? Now coupon rate of the bond should be not mixed up with the bond yield. Bond yield is more realistic. Let me explain it by giving you an example. Suppose there is a bond with 15% coupon rate. try understanding this example very well. The bond is with a 15% coupon rate and the face value of the bond is 1000. So anyone will believe that, okay, the bond is giving 15% returns. So let us invest into this bond. When you look into the market price of that bond, the market price of that bond is not 1000. Market price of that bond is suppose 3000. So you will be getting 15% coupon rate, but 15% coupon rate you will be getting on the face value of the bond, that was 1000. So 15% of 1000 will be 150. But to purchase that bond today you have to invest rupees 3000. So logically, when you compute your rate of return as an investor, what you would find that you are going to earn a coupon payment of 150 by investing 3000 rupees today. If you find your rate of return, that will be 150 divided by 3000, it will give you 5% return only. That 5% is what we call as current yield. Though the bond is offering a coupon rate of 15%, but for the investor the yield will be only 5%. That is the meaning of bond yield or the current yield of the bond. However, sometimes this kind of bond, I just gave you an example, this kind of bond could have various other benefits at the later stage. For example, there may be little higher coupon payments at later stage. There may be high redemption price payable on the maturity of the bond, but you will get that high returns when? Not while you are holding the bond just for 1 year or a shorter span. That kind of benefit you will be getting if you hold the bond till maturity. That yield of a bond is called yield to maturity. So after current yield, yield to maturity. Let us compare these two. Current yield of a bond is the yield that would be earned by you immediately in the current period. Yield to maturity is the internal rate of return of the bond which you will earn over the life of the bond. That means if you want to earn that kind of rate of return, you will have to hold the bond till maturity. That is why it is called yield to maturity, in short YTM. Now, what if the bond is a callable bond? For example, once again, I am issuer of the bond, you are holder of the bond. The bond that I have issued is a callable bond. If the bond that I have issued is a callable bond and it can be called upon at 5th year from the date of issue, you will be identifying that such a bond has 2 stages in its life. Issue date is now. After 5 years, call date will arise, and after 10 years from the date of issue, the maturity will arise. Now what happens? You want to find the yield of the bond, but it is not in your hand, right? If the bond issuer wants to call back the bond issuer may call back the bond at 5th year. If the bond issuer does not exercise the option of calling back, the bond will be redeemed at its maturity. So how much yield you will get up to the call date if the bond is called upon? Or alternatively, what will be your yield to maturity if the bond holder is holding the bond till maturity? Obviously, only when the bond issuer did not exercise the call option. In other words, the bond issuer did not repurchase the bond at the call date. That is why yield to maturity is the yield or the return of the bond up to its maturity, whereas yield to call is the yield or the return of the bond up to its call date. Then we have other two terms as zero coupon bonds and deep discount bonds. Let us understand these terms as well. Zero coupon bonds. Zero coupon. Coupon rate is basically the interest rate committed on that bond, where the issuer is promising the holder of the bond or the investor that such and such rate we will commit, and that coupon rate is applicable on the face value. We have learned that. When I say zero coupon bond, means no coupon payments will be made at all. So the question arises, why the investor would invest? So the idea is, the bond may have, say, a face value of 1000 and the bond is issued just at 400 and it will be redeemed at par value, that is 1000. So today at the time of issue of bond, as an investor you have to invest just 400, and on its redemption date, on its maturity date, the investor will get back 1000. That difference between the purchase price of the bond and the redemption price of the bond is the yield of the bond. That kind of bond is called zero coupon bond. Now zero coupon bond and deep discount bonds, many students they perceive it as if they are one and the same. Their nature is similar, but they are not same. They may be little different. Let me give you an example. A zero coupon bond and deep discount bond, both are same in respect of one thing, that they are not providing any coupon payments to the investor. No coupon payments at all. But there is a difference. Zero coupon bond is a broader category, whereas deep discount bond is typically a type of zero coupon bond. Means zero coupon bond could be a bond that is issued at par or discount, redeemable at premium, or maybe even at par. For example, a zero coupon bond can be issued at par and redeemed at premium. It may be issued at discount and redeemed at par. It may be issued at discount and redeemed at premium. Ultimate objective is the issue price and redemption price should have a gap to motivate the investor to invest their money. On the other side, deep discount bond has a typical meaning. It is such category of a zero coupon bond which is necessarily redeemable at par and issued at a substantial discount. So if you talk about the definition of deep discount bond, I would say deep discount bond is such a zero coupon bond which is redeemable at par but issued at a substantial discount. Annuity bonds. Now I'm sure you people know the meaning of the word annuity. Annuity indicates a constant payment every year, correct? A constant payment every year. In that case, what happens? The bond will provide the investor a constant cash flow up to its life, but there will be no redemption price. So what happens? Along with the coupon payments every year, there will be a portion of the bond's principal amount which will be redeemed. So that interest plus the redemption amount taken together becomes annuity. So to find what would be the rate of return on such an annuity bond, that could be something very, very important, because it is not giving you any coupon payment or any redemption price. It is just giving you constant payments every year in the form of annuities. And one very, very important term is about par bond, premium bond and discount bonds. Many students, they have misunderstanding with respect to this term. They believe that, okay, par bond means bond issued at par, premium bond means bond issued at premium, discount bond means bond issued at discount, the end of it. No, it is not like that. It is not like that. There are two different stages at which you have to understand this term, par bond, premium bond, discount bond. Two different stages. One is the first stage, that is in the primary market when the bond is originally issued. That time you can say that yes, a bond which is issued at par is a par bond, bond which is issued at premium is a premium bond, bond which is issued at a discount is a discount bond. Fine. But what happens later? What you are saying is applicable only at the issue of the bond, at the time of issue of the bond. But what may happen at later stage when the bond is already issued? That time you would see that 1,000 rupee face value bond, its market price may be 1,000, or you can better compare it with the intrinsic value. Its intrinsic value is also 1,000. So 1,000 rupee face value and 1,000 rupee intrinsic value. Then you will call that bond as a par bond. If the bond's intrinsic value is found to be greater than its face value, we would call it as a premium bond. If the intrinsic value is less than the face value, we will call it as a discount bond. So imagine 1,000 rupees is the face value of the bond, and after the issue date, what is the market price? Let us not go into that. but the intrinsic value of the bond, which is the true value of the bond, is also 1000, then you call it par bond. If it is 980, you would call it a discount bond. If it is 1050, you would call it a premium bond. So comparison can be between the issue price and intrinsic value, or you can say the face value and intrinsic value, or the comparison could be between the intrinsic value and the market price. Which comparison you are making and what will be the purpose of that comparison, we are going to discuss all those things in much details ahead. So let us move ahead with some notes over here. What is the intrinsic value of bond? Because I have been talking a lot about intrinsic value, intrinsic value, intrinsic value. I have been referring to that as a true value of the bond. So what is this? Basically, intrinsic value is the present value of the bond's cash flow. A bond will be offering you cash flows in the form of what? A bond will be offering you cash flows in the form of what? In the form of coupon payments and redemption price. Coupon payments and redemption price are the future cash flows. You being an investor, you have a certain expected rate of return. You discount those future cash flows to its present value by considering discounting rate as whatever be your expected rate of return. And you should keep in mind one thing, your expected rate of return has to be a realistic rate. It cannot be a fancy rate. That way, someone will say, no, I would want to expect 25% return. I would want to expect 40% return. That is not going to happen, right? You are trading in a bond. A bond's rate of return that is prevailing in the market, you have to observe that rate. That kind of rate of return will become your expected rate of return. If you have unnecessarily high expected rate of return, nobody is going to provide you that rate of return. So, logically, if I am an investor and if I say my expected rate of return is 10%, there is a rationale behind that expected rate of return being 10%, because if you are not giving me 10% returns, I will have investment opportunity where I can invest my money at 10% rate in some other bond, in some other debt instrument. If I am investing in this particular bond, I am sacrificing the opportunity to earn 10%, and that is why 10% becomes my opportunity cost of capital, and that is why 10% will become my expected rate of return on that bond. What I am trying to tell you is, your discounting rate has to be your expected rate of return, which cannot be any fancy rate. It has to be a realistic rate. So, what is the meaning of intrinsic value? I just explained, and how to determine this intrinsic value, that also I explained. It is computing the present value of all the future cash flows. So, intrinsic value of the bond is the true worth of the bond. It is determined by taking the aggregate present value of coupon payments and redemption price over the remaining maturity period, where the discounting rate is the expected rate of return or the desired yield rate by the investor. Now, one thing very, very important, many students commit mistakes in exam. So, please keep it as a matter of caution. Suppose I tell you that a bond has a life of 10 years. Okay, and the bond's coupon rate is so much, its face value is so much, and its market price is so much, its redemption amount is so much. Determine the intrinsic value. And I mention one more thing, that the remaining life of the bond is 6 years. Now use one thing. If you consider 10-year time horizon and compute intrinsic value, you would have computed that present value or intrinsic value 10 years back. That means at the date of issue. Whereas now I am mentioning that the remaining life of the bond is 6 years. So what you have done, if the 10-year bond life in total, and now I say that the remaining life is 6 years, means after the issue, the period that is already lapsed is 4 years. Now you are not going to receive those coupon payments. The cash flow that you will get in future will be the cash flow for upcoming 6 years only. So you should consider the remaining maturity for computing that present value. That you should keep as a caution in your mind. Otherwise you would end up committing the same mistake which plenty of students commit. So that was about what is the intrinsic value of the bond and how to determine that. Now let me put you at a particular example. What I'll do is I will just display a question over here. I'll give you a few minutes to think over it, and let me see if you can give me the correct answer. Okay, so I will not say a word about it. I will just keep the question over here on display, and I would want you to think over it and give me the answer if possible. And I'll just wait for a while. Put down your answers in the comments, and let me see whether you can get the answers correct. So if you are clear with the meaning of what is the basic terms of all these bond valuation or the related matter, you should be able to give me the correct answers. I'll just give you 3 minutes time, and your time starts now. All right, I have given you enough time to figure out these answers. So what is basically demanded over here, if we can observe, the face value, the issue price, the coupon rate, the coupon payment, the maturity date, redemption price, market value as on 25/3/2018 and intrinsic value on 31/3/2018. Other than this 8th requirement, the first 7 you can just find as a direct information in the question. It is just about how to correctly compute the intrinsic value. So when I display the answer over here, I would want you to identify whether you were correct with this or not. The face value of the bond will be ₹1000, and as the bond is issued at the par value, the issue price will be equal to its face value, that will be 1000. Coupon rate is 8%. Coupon payment will be 8% of the face value, that will be ₹80. Maturity date is 31/3/2024, and the redemption price will be 10% premium promised by the issuer. So it will be face value plus 10%, that will be 1100. The market price as on the given date is 1023. So as I told you, these 7 points were directly mentioned in the question itself. What you had to compute was the last part, that was the intrinsic value. Now, if you could see from the year 2018, that is 31/3/2018 till the maturity of the bond, that is 31/3/2024, the remaining life of the bond is 6 years. So, you are going to compute the present value of cash flows over the next 6 years. How would you do that? Just plot a small table. From year 1 to 6, you will be getting cash flow of rupees 80 every year, and at 6th year, you will be getting the redemption price of 1100. Then what you do is you compute the annuity factor for 6 years at discounting rate of 10%, because 10% is your expected rate of return, and the present value factor for 6th year for this redemption price. And when you apply this present value factors or annuity factors to the related cash flows, you will be getting the present value of those respective cash flows. The aggregate present value will be the intrinsic value of the bond, which comes to 969.34. So, quickly look into this and check whether you were correct with this or not. And as I told you, we cannot afford to write up all the answers and solutions in detail. So, you just quickly refer whether you got the answer correct or not, and then I take you ahead. So, the final answer, intrinsic value, it is 969.34. Let us move forward and deal with what are par bonds, premium bonds and discount bonds. I have explained to you this whole thing already. At the time of issue, if the bond is issued at its face value, it is a par bond. If issued above its face value, it is premium bond. And if it is issued below its face value, it is a discount bond. Once the bond is floated in the market, when the bond starts trading activity, that means the investors are buying and selling the bond in the secondary market, that time if intrinsic value equals to its face value, it is par bond. If the intrinsic value is higher than its face value, it is premium bond. If intrinsic value is lower than its face value, it is discount bond. So, let us move forward. We have discussed that point already. Next question that comes up is how to identify whether the bond is fairly priced. So, in order to identify whether the bond is fairly priced, what you just need to do is you need to find the intrinsic value, and the intrinsic value should be then compared with the market price. If you find that the market price of a bond is equal to its intrinsic value, it will be considered as the bond is fairly priced. If the market price of the bond is higher than its intrinsic value, then such bond is considered to be overpriced. And if the market price of the bond is lower than its intrinsic value, such bond is considered to be underpriced. If the bond is underpriced, what you would do? You would buy such bond. If the bond is overpriced, what you would do? You would prefer selling such bond. So, this whole thing I have already explained to you while we were talking about the basic terms. So, while you are handling the questions, and when the question is asking you, should the investor buy this bond, you have to compare simply the intrinsic value and the market price, identify whether the bond is underpriced or overpriced or fairly priced. If it is underpriced, you should buy the bond. If it is overpriced, you should better sell the bond. So, let us move ahead and look into another question. That will be second question over here. Face value of the bond is given as rupees 1000. Coupon rate is 9%. Coupon payments at end of each year. And remaining maturity is 4 years. Bond is redeemable at 15% premium. The present market price of the bond is rupees 1020. The desired rate of return for the investor is 11% per annum. Determine whether the bond is overpriced or underpriced in the open market. Should the bond be purchased? So, what you are going to do when you are reading this question, you just have to do one thing. You just have to find the intrinsic value of the bond. if you are able to find the intrinsic value of the bond, you just have to compare the same with the quoted market price, that is 1020. So the current market price prevailing in the market, or I would rather say secondary market, is known to us. We just need to use this other information to find the intrinsic value. Now to find the intrinsic value, coupon rate is given and face value of the bond is given. So 9% of 1000, rupees 90 will be the annual coupon payment, and the remaining maturity is 4 years. That means each year you will be getting 90, 90, 90, 90, and thereafter it will be 15% premium that will be paid on redemption. So redemption value will be 1000 plus 15%, that will be 1150. When we know the future cash flows, we also know the discounting rate, we will have absolutely no trouble in finding the intrinsic value of the bond. Let us look into that. So the manner in which you compute this intrinsic value, it is straight and simple. Now some students have been asking me that, sir, how to calculate these PV factors. Now at final CA or final CMA stage, if you are asking me how to compute PV factors in bond valuation, it is little absurd. So I would say that fine, if you still have that point of doubt, you can always refer to my basic videos on intermediate financial management, where I have explained in detail under the topic heading time value of money. Okay, so once you compute these annuity factors and PV factors, you multiply these factors to their respective cash flows and you will obtain the present value of cash flow, which will be summing up to what we call as intrinsic value, which is 1036.76. Now this is the true value of the bond, this is the fair value of the bond, and the current market price of the bond is 1020, means a bond which has a fair value of 1036.76 is traded in the market at just 1020, means it is underpriced, and therefore you can purchase this bond. So the bond is underpriced, hence the bond can be purchased. That is the conclusion that you will draw. I'm sure you people have understood this whole calculation in relevance of the concept what we have discussed. Moving forward, we will now talk about yield to maturity. Now what is the meaning of yield to maturity? I have explained to you. Yield to maturity is the overall yield of the bond if the bond is held till maturity. Basically, from the investor's viewpoint, this is the IRR of the bond, that is the internal rate of return of the bond. A bond is going to give you certain cash flows in future, and currently you are buying the bond at a certain market price. The future cash flows should be matched with this current market price. Whichever discounting rate can match it up, that becomes the appropriate discounting rate or the IRR of the bond, that is internal rate of return of the bond, and the same thing can be considered as yield to maturity. Now this part needs recollection of your IRR concept that you have learnt already at intermediate levels. So just to give you a quick reminder, you approach the IRR calculation through a method called trial and error method. So you begin with a random rate which will be considered as an discounting rate, and apply that rate, compute the present value of the bond, try to match the present value with the current market price. If it is matching, whatever discounting rate you have picked up, that discounting rate will become the YTM of the bond or yield to maturity. If the discounted value, the intrinsic value, is not matching with the market price, that means to bring it at par with the market price, the next rate of discounting that you have to select should be higher or lower than what you have picked earlier. Now whether to pick a higher rate or to go for a lower rate depends upon what is the present value that you have obtained. You should know one thing, that the present value of the cash flows is always inversely related to the discounting rate. The higher the discounting rate, the lower will be the present value, and vice versa. So depending upon how you are getting the present value, comparing that with the current market price, you will get to know what will be the next rate that you have to try. So what happens when you build a good smartness about how to determine that approximation, you will be able to quickly land up at the right rate. I can give you a shortcut as well, okay, but that requires a separate application of an approximation method, but it will give you a hint that what would be approximately the discounting rate which can match, and so that you can find a range of two rates. One can be called as lower discounting rate, another could be called as a higher discounting rate, and that lower and higher discounting rates, when you try to interpolate, you use interpolation technique in mathematics. Through that interpolation, you'll be getting an approximate rate of return between that higher and lower rate, and that will be the YTM of the bond. And because this calculation is obtained through approximation using interpolation, it will never give you accurate result, it will be always an approximation. So this is something very, very important at your level, and you should not ignore preparing the YTM calculation. So what is the yield to maturity? I have explained to you. You can just quickly give a reference to this particular note, what is referred over here. This is a rate of return which is generated by a bond over a period up to its maturity. If the future cash flows of interest and redemption price are discounted using YTM, the present value of such cash flow will be equal to its actual market price. A rate of discounting which can make the intrinsic value equal to the actual market price can be considered as YTM rate. Now, merely talking about it will not be enough. You need to understand the calculation process. So let me take you to an example given in question number 3. Look at this example. Face value of the bond is given as 1000, redeemable after 4 years at 1200, and the coupon rate is 8% per annum. Determine the yield to maturity if the present market price of the bond is 1050. So first of all, observe one thing. As I told you, you don't have to pick exactly what we call as a random rate to get started. You can systematically pick a rate using your simple common sense. Bond is already giving you 8% coupon payment, means on the par value of the bond, 8% you are earning already. Now look at one thing. If you buy a bond today at 1050, it is going to give you the redemption value of 1200. Means today you can buy the bond at 1050 and the bond will give you something more than that in the form of redemption value. That means the bond is giving you 8% coupon payment anyway. On top of that, it is giving you some hike over the money that you have invested. As a result, you are definitely going to earn more than 8%. Now tell me, isn't that a hint that you are going to earn something more than 8%? So what I would do, I would try computing the present value or the intrinsic value of the bond using a discounting rate which will be little higher than 8%. So I'm making a trial at 10%, and let us see what we get. When we are computing the present value of this bond using 10% discounting rate, we find that the present value of the cash flow, which is the intrinsic value, is coming as 1073.19, and the quoted market price of the bond is 1050. So you can understand one thing, your computed intrinsic value 1073.19 is little higher than the quoted market price of 1050. Your objective is to bring down the intrinsic value to match with the quoted market price. That means you have to bring down the intrinsic value. Bringing down the intrinsic value means the discounting rate that you have to select as the next rate should be a little higher rate. So my first trial, I just made an approximation with 10%, and now I get a hint that 10% is the initial rate that we picked up for a trial. Next rate that we have to pick up for a trial should be little higher than 10%. Little higher than 10%, obviously I would consider maybe 11%. So what I do is I take one more calculation exactly the same way, and I find that the intrinsic value of the bond using 11% discounting rate Now you have understood how to compute the intrinsic value. That intrinsic value at 11% discounting rate is turning up to be 1038.68, which happens to be little lower than the quoted market price of 1050. One thing is confirmed, that the yield to maturity of the bond is greater than 10%, but it is lower than 11%. As a result, you will be finding that the YTM of the bond will be between 10% and 11%. Once you conclude this much, the next stage is to use technique like interpolation and find out what approximate rate between the lower and higher discounting rates you can get. So I have explained this particular concept in detail in another YouTube video of mine that is just focusing on YTM. I'm not going into those details of explaining the logic behind interpolation right now. If you have learned that logic behind interpolation, that's fantastic. If you don't know that, I would recommend you to watch that video on bond valuation YTM, where I have explained the matter in detail. So logically, what we do is we find an approximate rate between 10 and 11%, and what we do, we just find this through a technique called interpolation. Now what I have mentioned over here is a logical approach, and if you can follow that logic, that is the best. If you don't want to follow that logic, or if this becomes little tedious for you, comfortably you can use a formula which I'll mention over here. So this interpolation formula can also be applied. It is basically a formula derived from the same logic that we have seen earlier, and this formula would give you exactly the same result. So between 10 and 11%, what approximate rate would indicate YTM, that is yield to maturity? The answer what we are getting is 10.672%. Notice one thing, every time we are making this calculation, we are writing words approx, because this will not be the actual rate of return, this will be an approximate rate of return. Once again I am telling you, if you can follow the logic, that is better. If you cannot, you can use this formula. Both are okay, you can do any what you feel like. But my concern right now is what? My concern is, if you are willing to know the logic and you are not aware of that logic till now, I would recommend you to watch that particular video where I have explained in detail the YTM logic through interpolation. So as of now, I'll move ahead. Guys, these are revisionary classes. I cannot afford to, go in much details over here, because your objective and my objective will be to quickly have a brush up of all these concepts and calculations. So moving forward, this is a kind of approximation approach which you would have learned at intermediate level, which can give you a hint of where could be the lower and higher discounting rate. C stands for coupon payment, R is the redemption value, P is the market price, divided by N, N is the remaining maturity, and the denominator over here is the average of R and P. So when you apply these calculations, you would find an value, you would find a rate which can be considered as an approximate rate, which can give you approximation of YTM. So this YTM, look at this point, this formula what is written over here also follows a logic. See, for the investor, annual coupon payment is an income. So rupees 80 every year is an income. The redemption price is 1200, current market price is 1050. So 1200 minus 1050 would give you the differential of 150, but that differential you will be earning over a period of 4 years. So annually your benefit comes to 1/4 of this difference. So 150 divided by 4 years would give you what? 37.5. And today the price of the bond is 1050. After 4 years its value will be definitely 1200. So the average value is the denominator. 1125 is nothing but the simple average of 1200 and 1050. Now when you use this, you are getting 10.44% as approximate YTM. The moment you get 10.44% using this approach, you get a hint that you will be finding the YTM between 10% and 11%. That is the biggest hint that your YTM lies between 10% and 11%. So you may use even this kind of approach for making that approximation. So it is all up to you how you want to make the calculation. In your exams, you are not supposed to do this as your calculation. This is for getting approximation. So your real approach for computing YTM is not this one. It was the one that was explained earlier. So please use that, and you may use this just for finding that approximate discounting rate for you to get started. Now, what are annuity bonds? I have explained to you already while we were discussing. So quickly read out this particular line, what is written about annuity bonds. These bonds are paid over a period of time by the same amount of cash flows each year. Therefore, there is neither any coupon payment nor any redemption price. All the cash flows of these bonds are spread over their life by ways of annuities. So as I told you, here there will be no coupon payment or redemption price. These are annuities that will be paid over the life of the bond. Let us take an example to understand this particular concept, and that is given in question number 4. Let us read this. Issue price of an annuity bond is rupees 1000. Bond pays an annuity of rupees 170 per annum over 10 years of its life. Determine the intrinsic value of the bond if the desired yield rate is 11% per annum. This is going to be a simplest of calculation. So what you will do, 10 years of life and 11% is the expected rate of return. You find the annuity factor at 11% for 10 years and multiply that to 170. That will be the intrinsic value of the bond. That's all. So just one line calculation. So what you need to do, just you may draw the table, and for years 1 to 10 the constant cash flow is 170. At 11% for 10 years time, the annuity factor would come out to 5.8892. And when you apply that over 170, it comes to 1001.16. So the intrinsic value is 1001.16. This is how you compute intrinsic value of an annuity bond. Moving forward, we take up yet another question, that will be question 5. Intrinsic value of an annuity bond is 1086. They have given intrinsic value of the annuity bond. Desired yield rate is 10% per annum. Remaining period of maturity 6 years. You are required to determine the amount of annuity receivable by investor every year. So look at one thing. What happens here? The question has given you the intrinsic value already, and you know how did we obtain the intrinsic value? The intrinsic value was obtained by multiplying the amount of annuity with the annuity factor, and you get the intrinsic value. This time intrinsic value is given, but amount of annuity is missing. So simple logic is amount of annuity multiplied by annuity factor will give you intrinsic value. So this time you have intrinsic value available in the example. So what you will do, pick the intrinsic value, determine the annuity factor. When you divide intrinsic value by the annuity factor, you will be getting the amount of annuity. So let us look into that calculation quickly. PV factor of an annuity for 6 years at 10% per annum is 4.3553. We know that intrinsic value is annuity amount into the PV factor or annuity factor. So 1086 equals to annuity amount into 4.3553. So annuity amount will be 1086 divided by the annuity factor, that is 4.3553, and what you get is 249.35. So please check this calculation and then we move ahead. All right. Time for us to move ahead. Changes in the value of the bond. Now something important over here. When the bond is nearing its maturity, you know what is going to happen? The intrinsic value by default will come closer and closer to the redemption price. So keep this thing in your mind clearly. Imagine that there is a bond with a face value of 1000 and the bond has, say, remaining life of 3 years. Bond is going to be redeemed at 1200 and the intrinsic value, when you compute now, suppose that intrinsic value is coming as 1100. Bond is going to be redeemed at 1200. Now its intrinsic value is 1100. That means the intrinsic value is lower than the redemption price currently. Fine. As and when the bond is nearing its maturity, the intrinsic value will become closer and closer to the redemption price. On maturity, after the coupon payment, the intrinsic value and the redemption price both will be same, because the worth of the bond that point of time will be exactly matching with the redemption price. So when the bond's redemption price is greater than intrinsic value, it is implied that over the remaining maturity, the intrinsic value of the bond is going to constantly increase. Inversely, if the intrinsic value of the bond at present, it is greater than the redemption price, then over the period of remaining maturity, the intrinsic value will start declining. That is the concept about the changes in the value of the bond as and when it approaches its maturity. So let us read this line. The intrinsic value of the bond gets closer to the redemption price as and when the bond approaches its maturity. If a premium bond is redeemable at par, its intrinsic value constantly declines over time. You know what is premium bond, right? A premium bond means its intrinsic value is greater than its face value and it is redeemable at par, means it is going to be redeemed at its face value. So a premium bond which is redeemable at par means its intrinsic value at present is greater than its redemption price. So obviously over the remaining maturity, its value will constantly decline over time. If a discount bond which is redeemable at par, then its intrinsic value will constantly rise over time. Now to have much better understanding of this particular concept, I have designed a simple question for you. That will be question number 6. So what I'll do is I'll give you maybe a few minutes to read this question and see if you can give me the answer, and just do the calculations. No need to make the detailed working, and see if you can get the correct answers. Let us check. Let us quickly check. So I'll give you exactly 3 minutes from now. Your time starts now. All right, I have given you enough time over here to try making these calculations. So let us see what you obtained and whether it was correct. Face value of the bond is rupees 1000 and it is redeemable at par. Coupon rate is 10% and desired rate of return is 9%. Simple logic is, if the desired rate of return is less than the coupon rate, means the bond is offering you a rate of return which is greater than your expected rate of return, it is obvious that the intrinsic value of the bond will be higher than the face value. So when the remaining maturity is 5 years, you will find that the bond is a premium bond and its intrinsic value is greater than 1000. So when you compute, the value that you are getting is 1038.87. This is the value when the remaining maturity is 5 years. Likewise, you have to compute when the remaining maturity will be 3 years. So we know one thing for sure, that currently the intrinsic value is greater than its redemption price. As and when the bond is going to near its maturity, this intrinsic value will start declining. Look at the calculations ahead. When the remaining maturity is just 3 years, and when you recompute the intrinsic value using the same approach, you will be getting intrinsic value still higher than the redemption amount, but it will be definitely lower than what it was earlier. Earlier it was 1038 something and now it is 1025.33. When the remaining maturity is just 1 year, you will be getting 1000 rupees of redemption value and 100 rupees of coupon payment. So 1100 is your cash flow. In 1 year time, the present value comes to 1009.17, and when the remaining maturity is 0 year, that is at the redemption date, its value will be exactly matching with the redemption amount, that is rupees 1000. This is what we have discussed over there. Let us move forward, and now we talk about zero coupon bonds. I have already explained you what is the meaning of a zero coupon bond. I don't have to explain you again, just revise it. These are bonds which do not provide any coupon payments. These bonds are either issued at nominal discount or at par and redeemable at a significant premium. The present value of cash flow from this bond considers only the present value of redemption price, which is its intrinsic value. With maturity date coming closer, the intrinsic value of such bond increases. Now obviously the redemption price of this bond will be significantly higher than the intrinsic value. So as and when the bond is nearing its maturity, its value will always go on rising up. That is the peculiar nature of zero coupon bond. And we have also discussed what are deep discount bonds. In one line, I would say these are such zero coupon bonds which are redeemable at par but issued at significant discount. Moving forward, we have callable bonds. We have discussed about callable bonds. A callable bond is such a bond that provides an option to the issuer to call for redemption at a specified date before maturity. Such bonds are generally redeemed before maturity if the interest rate in the market declines. Now this point is important. That is the only reason I am discussing this matter once again. Look at one thing. There is a callable bond. Logically, when will the bond issuer exercise that callable bond option? That is the option to call back the bond for premature redemption. Imagine that a bond was issued 5 years back. The bond had total life of 10 years and bond was callable at 5th year. And now the call date has arrived. When you issued the bond, you have promised the coupon payment of 10%. After that time, in the market, the rate of interest prevailing for such type of bonds started declining. And now the prevailing rate is just 7%. Means if you want to issue new bonds today, you can issue at 7% coupon rate. but your existing bond is offering 10% coupon rate, why should you unnecessarily incur 10% cost on your funds borrowed, where you can borrow funds at 7%? This is the time when the issuer of the bond will exercise the option to call back the bonds, so that the bond can be favorable, or the exchange of the bond, that is issuing the new bond at 7% coupon rate, and redemption of this bond or calling back this bond will be a beneficial activity for the issuer. That is the biggest advantage of callable bonds. So keep in mind one thing: such bonds are generally redeemed before maturity if the interest rate in the market declines. The call date is a specified date at which the issuer can call for premature redemption, and the call price of the bond is the price payable on the call date if the call option is exercised. I have explained you all these points already. The only point that I wanted to explain additionally was this point, that is, which will be the scenario where calling back the callable bonds for premature redemption will be beneficial for the issuer of the bond. So we have also talked about puttable bonds. A puttable bond is such a bond that provides an option to the holder of the bond to put back, means to claim the redemption at a date specified already. That date has to be a date prior to the redemption or maturity date. That was about puttable bonds. Yield to call, I have explained you what is yield to call. Yield to call is just like yield to maturity, but not considering the period remaining up to maturity, but considering the period only up to the call date, and the cash flows will be based on not the maturity but based on the call date. So YTC is applicable first of all only for callable bonds. YTC is determined just like YTM. The applicable rate of redemption, the applicable date of redemption will be the call date and not the maturity date, and the redemption value will be the call price. Considering all these factors, the way you compute the IRR of the bond, which is YTM, but if you consider the redemption date as call date and redemption value as the call price, what you obtain as IRR of the bond up to the call date, that will be the yield to call. Now this point is something important, and I am expecting that there may be questions, either theory questions or calculative examples based on bond strips. Look at this. STRIPS is an acronym for separate trading of registered interest and principal of securities. Interest and principal, those two streams can be traded separately. That is the objective. So the present value of cash flows from such a bond can be divided into two categories: the present value of the interest or the present value of coupon payment, which is called interest strip, and present value of the redemption price, which is called principal strip. The investor has option to buy or sell the interest strip and principal strip separately. I would just ask you to read it for your reference once again and be clear with what exactly is the meaning of bond strips. After this, we will be having a calculative example on bond strips. So I'm sure you have read this point and you are clear with this. So the peculiar nature of this is the two streams of the cash flows, the interest and principal, can be traded separately. For your reference, let me tell you the terminology that you may find used in exam questions could be stripped bond. That what are stripped bonds? Bonds which are stripped bond means where they are stripped into two components, where interest strip can be traded separately and principal strip can be traded separately. So stripped bonds, bond strips, both can be used as terminology in the question. So don't get confused, it is one and the same. Let us take a calculative example to understand this. and that will be question number 7 given in your sheet. It says face value of the bond is 1000, coupon rate is 9%, coupon payments are made at end of each year, the remaining maturity is 4 years. Bond is redeemable at 15% premium. The present market price of the bond is, now can you see two types of market price given, 820 for the principal strip and 260 for the interest strip. That means it itself is conveying that because both the streams of the cash flows are being traded separately, obviously they both will have different market price. If the desired rate of return of the investor is 11% per annum, determine whether the bond strips are overpriced or underpriced in the open market. So what you need to do, just need to compute the present value of the cash flows, the way we compute intrinsic value. That is what you have to do. But instead of taking the entire aggregate of the intrinsic value, you find the intrinsic value only for the principal strip and you find the intrinsic value only for the interest strip. Compare the intrinsic value of interest strip with its quoted market price, and likewise compare the intrinsic value of the principal strip with its quoted market price to identify which strip is underpriced and which one is overpriced, or are both underpriced or are both overpriced, or the whole component is fairly priced. You will come to know only when you make the required calculations. So you understood what you need to do over here. Let us see how to present the calculations over here. Look at this. We are just computing the intrinsic value of the bond the way we always do, and when we find that intrinsic value, it is coming as 1036.76. but here this is not of the concern. What is concern is the individual present value of these two strips, and therefore we are now talking about both the strips separately, the interest strip and the principal strip. The intrinsic value what we obtained is 279.22 and 757.54. Now what is the quoted market price of these individual strips informed in the question? The quoted price, it is 260 for the interest strip and 820 for the principal strip. Now compare, you find intrinsic value as 279.22 and quoted price as 260, means the quoted price is less than the intrinsic value, means interest strip is definitely underpriced. On the other side, look at what is happening. Intrinsic value of the principal strip is 757.54, but it is traded in the market at rupees 820. So it is implied that the principal strip is overpriced. So we conclude that the interest strip is underpriced and the principal strip is overpriced. So quickly have a glance at this calculation and then I take you ahead. Alright friends, I am sure you have followed this whole thing. Time for us to move ahead, and now what we do is we go to the next calculative example, which is again a very important example given in question number 8. Now this is really very important example. Please carefully pay attention on this. I will explain you the whole thing. Face value of the bond is given as 1000, coupon rate is 8%, coupon payments are made twice every year on half yearly basis. These bonds are redeemable after 4 years at 20% premium. Determine the intrinsic value of the bond if the expected rate of return is 12% per annum, and then they have given two cases. Case 1, it says based on half yearly compounding. Case 2 says based on annual compounding. Now please understand what exactly is the logic behind these two separate calculations. See, these are the bonds where the investor is going to receive the coupon payment not once but twice a year. These are basically bonds which are paying half yearly interest. So interest payment will be made twice during the year. If the coupon rate is 8% per annum, for each 6 months period, you will be receiving 4% coupon payment. Now 4% of face value 1000 is what? Rupees 40. You would receive 40 for every half year. So, you know, this time the life of the bond is 4 years, but you won't get a stream of 4 cash flows for interest. You will get a stream of 8 cash flows towards the coupon payment, because every half year you will be receiving 40, 40, 40, 40. Likewise, you will be having 8 such cash flow collections towards the coupon payment. So, for solving questions like this, you will not consider 4 years, but rather you will consider 8 half years. That is not a problem. That is not a complication. Problem arises in this part. When the expected rate of the return for the investor is 12% per annum based on half yearly compounding, means the investor also is considering 12% per annum for half yearly compounding, means the investor's expected rate of return is half of 12%, that is 6% per annum. So for half yearly compounding, it is 6% per annum. Sorry, for half yearly compounding, the 12% per annum will be treated as 6% for each half year. So simply what you did, 12% is the expected rate of return for the entire year. So for half year, it will be 6%, because the investor's expected rate of return is 12% per annum based on half yearly compounding. Then you can directly have half of 12 as 6% as your expected rate. The calculation of intrinsic value becomes plain and simple. On the contrary, if the investor says that, boss, I want to earn 12% based on annual compounding, then you cannot split 12% per annum as 6% for each half year. You cannot do that, because over there the compounding will happen only once a year, and that becomes little critical, and that you have to understand it very well. So let us understand how to deal with this situation. Carefully understand this. In your study material, they have given a couple of examples based on this kind of situation, and I have a strong intuition that you may be facing a question like this in your exams. So let me show you how to deal with the solution over here. When it is the case of half yearly compounding, the task becomes actually easier. Whatever was 12% per annum, you can split it into 2 halves. That will be 6% per half year. And as I told you, this time when you make the present value calculation, it will not be about 4 years, but 8 half years. So look at one thing. I did not write here year column. I wrote here half years. So there are 8 half years. Cash flow for every coupon payment is rupees 40, and during the 8th half year, you will be receiving the redemption amount of 1200. Now you will be computing annuity factor at 6% for 8 half years. It is just as if you know 6% for 8 periods. So the way you compute annuity factor, just use the interest rate as 6% and consider the period as 8. Likewise, you compute the PV factor of 8th half year using 6%. So as if it is 6% as the interest rate or discount rate, and 8 is the period. So once you get these factors, you apply these factors on the cash flows and you get the present value, which will be the intrinsic value. Plain and simple calculation. You just had to do one thing, because it is 12% per annum, which is your expectation for 1 year. For half year, your expectation will be 6%. But mind it, this can be done straight away only if it is the first case informed in the question. If the interest or if the expected rate of return of the investor is 12% per annum compounded half yearly, you can do this. If it is compounded annually, you cannot do this. What has to be done over there, I'll explain you in a while. I'll just give you a couple of minutes to understand this part of the calculation, and then I take you to the next part. All right, this will be the approach of calculation when the expected rate of return for the investor is 12% per annum based on half yearly compounding. What would happen in the second case if the desired rate of return or the expected rate of return for the investor is based on annual compounding? Here you have to be very, very careful. So, how to compute the effective rate? This is something important. You know, in 1 year, the compounding will be happening twice. The interest payment will be received twice. But our investor is having expectation of 12%, not based on half yearly compounding, but based on annual compounding. So fine, we don't know what would be the expected rate of return for half yearly compounding. So the annual compounding has to be transformed into half yearly compounding. So whatever be the interest rate, it will be divided by 2 first of all, because it is a half yearly interest payment. But in 1 year, the compounding will happen twice because the interest payment will happen twice. So whatever be the interest rate, that you divide by 2, and when you take 1 plus interest rate, it is 1 plus, not I over here, 1 plus I by 2, but this will be raised to 2 times because coupon payments will be made twice a year. This whole thing should be matching with the future value of 1.12. Means if you invest 1 rupee today, it should become 1.12 in 1 year time. So 1 will become 1.12 only, but the interest payment is to be received twice in a year, and we don't know what would be the expected rate of return based on half yearly compounding, because this 12% is the rate of return for annual compounding. So now 1 plus I by 2 the whole square is 1.12. So 1 plus I by 2 would actually give you square root of 1.12, and that comes to 1.0583. So I by 2 is 0.0583. So the desired rate of return equals to 5.83% per half year. So what happens in the previous case, we directly took half of 12 as 6% for the half year. This time it is not 6% for the half year, it is 5.83% for the half year. Let me logically explain this particular point to you. If you can pick your calculator, see, your expected rate of return for the half year period is 5.83%. So suppose you have invested 1 rupee, 1 rupee would become how much after half year? So it will be 1 into 5.83% that will be added. So your 1 rupee in half year's time will become 1.0583. So I have added 1. So the 1 rupee that you invested, your expected rate of return was 5.83% for the half year. So 1 rupee became 1.0583 in half year's time. Then you will again apply 5.83% on 1.0583. Let us do that. So this 1.0583 into 5.83%, when you add to this, it becomes 1.12, because your expectation was what? 1 rupee on annual basis should become 1.12 because your expected rate of return was 12% per annum compounded annually. But because here the interest payments were made half yearly, your calculation has to be half yearly compounding calculation, but interest rate for half yearly compounding was unknown. That is why we computed the equivalent rate as 5.83%. Now, this calculation, as I said, is something very, very important, and please carefully take note of the same. I'll do one thing. After this, I'll be just having a few more questions which are meant basically for your practice. All the concepts that are involved in your study material I have covered by the time we have landed up to this particular question. Now, I would want to have your simple opinion over here. The next three questions, before we progress with that, you can see the use of that 5.83% we have done over here for computing the intrinsic value, and the intrinsic value over here is little higher than what you got earlier, because there for every half year your rate of return expected was 6%. Now it is 5.83%. So please carefully identify the difference between the calculations made in case 1 and case 2, and I would want you to tell me one more thing. The next three questions that I have are meant basically for your practice. So just give me your opinion whether you would want me to discuss those questions right away, or should I give you some time till tomorrow, you try it out on your own, and in tomorrow's session I check your answers. So just one word response I am waiting from your side. The next three questions which are meant for your practice, you would want me to discuss them now or tomorrow. Just one word response is what I am expecting, now or tomorrow. I did not get any response from your end, and I would say that let me not put any further time on just solving few more examples. You can try out those questions on your own. In your sheet I have given 3 more questions from this part bond, that will be question number 9, 10 and 11. Good questions, you should definitely try it out. What you can do is you can just have the switch over to the next topic, that will be equity valuation, which is again provided to you in that same sheet. So I'll just switch over to that other slide. Just a moment. So please write up the heading in your notebooks as equity valuation. This part, equity valuation, is having a lot of connection with what you would have learned at intermediate level, but yes, you definitely have references of this. And the question is why I am discussing this topic right now. See, the main topic that I wanted to discuss today, that is the portfolio topic. So when I am discussing the portfolio topic, we would want to have a very good understanding about that, and equity valuation and bond valuation concepts. If these are clear, your approach with portfolio management will be much better. So under the title equity valuation, you should first understand how to determine KE. KE is referred to as expected rate of return by the investor who is an equity shareholder. And you should also know that whatever be the expected rate of return by equity shareholder, the same thing is considered as cost of equity from the point of view of the company. So when you are finding symbol as KE, you can interpret that as three different ways. One is expected rate of return by an equity shareholder. Second, it is cost of equity for the company, or you may also refer the same thing as equity capitalization rate. So we know one thing, that P0 equals to D1 plus P1 divided by 1 plus KE. Now understanding this particular formula is very important. This is the base valuation model formula. Base valuation. So imagine that you have purchased a share today and your expected time horizon for investment is just 1 year. So in 1 year's time, you will receive dividend for 1 year, and because your time horizon for investment is only 1 year, you would be selling the share at 1 year's time. This is just an assumption that you have invested only for 1 year. So you would be receiving the price of the share in your hand after 1 year. That will be the cash flow in your hand. So D1 is the expected dividend that you will receive at year end. P1 will be the expected share price that you will receive on selling the share at the year end. D1 and P1 will therefore be identified as future cash flows. And KE, as I told you, you being an equity shareholder, this is your expected rate of return. Any future cash flow, if it is divided by 1 plus your expected rate of return, it will obviously result into what? The present value of the future cash flows. And this is how we compute the present value of the share also. So if you are to determine the present value of any equity share, what you would do? Identify what is the expected dividend in 1 year time. What do you expect about the share price that would prevail after 1 year? That aggregate D1 and P1 you divided by 1 plus whatever be your expected rate of return, and you will land up at the present value of the share. Now once you know that this is the base valuation model, lot of formulas in financial management are derived from this particular model. So what are these variables? I have discussed with you already. D1 is the expected dividend receivable by year end. P1 is the expected market price of equity share that will prevail, or that is expected to prevail by end of the year. KE can be considered as expected rate of return by equity shareholder, also known as equity capitalization rate, or the same thing can be referred to as cost of equity for the company. P0 is the current market price of the equity share. Now, one thing very important, when you compute the P0 value using this approach, See, you are computing a P0 value, right? When you are computing a P0 value, it cannot be a quoted market price. It cannot be a quoted market price. If you are computing P0, it is the fair value of the share. That you have to compare with the quoted market price. You know the way we computed intrinsic value of a bond earlier by taking the present value of the future cash flows. Likewise, when you are computing P0, it is not the quoted market price, it is the fair value of the share. We generally don't call it as intrinsic value. We better call it as fair value of the share, because in share valuation, intrinsic value of the share could have a different meaning. So keep in mind one thing, intrinsic value of an equity share is something different. You know, you would have learned that when you go for asset based valuation, you take the realizable value of all the assets, you subtract all the liabilities which are expected to be paid, and you finally arrive at the market value of the net worth that is attributable to the equity shareholders. That when you divide by number of equity shares, you will be getting intrinsic value per share. That intrinsic value per share is asset based valuation. Therefore, we cannot use the same term for computing P0 over here. We would better call it fair value. Now, when you computed fair value, you would want to obviously compare with the quoted market price, and then you compare and identify whether the stock is overpriced or underpriced. And the same logic applies. If the stock is underpriced, you would prefer buying the same. If the stock is overpriced, you would prefer selling the same. So let us identify a calculative example over here. Very simple. Mr. X is to decide regarding whether he should invest in equity share of NJ Limited. Expected dividend receivable by year end on share of NJ Limited is 45. So this is D1. Expected market price of this equity share by year end is 300. So this is P1. Expected rate of return by Mr. X is 25% per annum, means this is KE. Determine the current market price of the equity share. Very simple. D1 plus P1 divided by 1 plus KE. That is what you have to apply. So what you will do over here is P0 equals to D1 plus P1 divided by 1 plus KE. This will be the formula that you will apply, and you will define the variables, put up the value of these variables in the formula. So P0 value will be 45 plus 300, D1 plus P1, 45 plus 300 divided by 1 plus 0.25. When you make the calculation, the P0 value what you get is 276. Now keep in mind one thing, once again I am telling you, when you compute P0, it is not the quoted market price. The symbol P0 indicates the current value of the share, or it may indicate the current price of the share. But when you are computing it, it cannot be the market price. When you are computing it, it is always the fair value, because market price which is quoted, how can you compute that, right? It is quoted in the market. Every moment that price will change. What is quoted in the market, you have to refer to the market price, correct? It is meant for reference, not for computation. When you are computing the price of the share at present, it is the fair value of the share. So this is 276 in this particular case. Now P0 equals to D1 plus P1 divided by 1 plus KE. What we have applied in this formula, I have told you, D1 and P1 are the future cash flows, KE is the expected rate of return by the investor, and P0 is the present value of the future cash flow. Now what I would say, when P0 is computed as above, it does not represent the actual market price of the share. It indicates the fair value of the share. Such fair value is then compared to the current market price. Such comparison can conclude whether the share is underpriced or overpriced, and accordingly the decision is taken whether you should buy the share or sell the share. So just have a reference to this particular line, and I'll then take you to some calculative examples where lot of connectivity between formulas can be explained. It is after this while that I can see one of the responses from a few students that they would want to discuss it now, but I think because of the latency in the communication, I could now see your message. So it is given by Nikhil SH. Oh, the student's name is same as my name. Fine, Nikhil. So I would request that because we have already moved ahead, you better do one thing. You try solving those questions, and I promise you, either in the afternoon session or tomorrow, whenever you are ready with your answers, we will definitely have discussion on those questions without fail. Those are beautiful questions. That is why I have brought it for you. Very nice questions, but we will discuss them later. So you better take advantage of this opportunity. You try solving those questions on your own, and let's see when we discuss it what would be your outcome. Whether you have done it correct or not, we can check. Fine, we will move ahead from here. Now just have a quick look at this. We have learned that P0 is D1 plus P1 divided by 1 plus KE. If I cross multiply, I would get 1 plus KE equals to D1 plus P1 divided by P0. Now if I want to find the value of KE, it will be D1 plus P1 divided by P0. From the whole thing you subtract 1. So this 1 plus KE, if I want to find KE from this equation, this 1 I have to shift back to right hand side, and from this whole calculation D1 plus P1 divided by P0, when 1 subtracted, you will be getting the value of KE. Now if I want to incorporate this minus 1 within this term, I can simply take D1 plus P1 minus P0 divided by P0, because minus 1 can be considered as minus P0 by P0. When brought within this term, it will be D1 plus P1 minus P0 whole divided by P0. Now this term, if I split, I will be getting D1 by P0 separate and P1 minus P0 by P0 as a separate term. So I get KE equals to D1 by P0 plus P1 minus P0 divided by P0. Now guys, if you understand one simple thing over here, see, there will be a growth in the share price. Suppose the share price today is 200, and after 1 year we are expecting the share price to grow to 220. So 200 of today is expected to become 220 after 1 year. The growth in the share price is by 20 rupees. 200 becoming 220, the growth is by 20, and the current value of the share was 200. So by percentage, the growth is 10%. So how did we compute growth rate as 10%? G standing for growth rate, we are computing that as P1 minus P0 divided by P0. So P1 in our example was 220, P0 in our example is 200. P1 minus P0, 220 minus 200 divided by 200 would give you 10% as growth rate. Growth rate is basically P1 minus P0 divided by P0. But we find that this term over here is also P1 minus P0 divided by P0. If we substitute this for G, you would be getting the value of KE. Recall in your intermediate syllabus, in your financial management, you would have learned this formula and applied this formula many times. K equals to D1 by P0 plus G. This is the manner in which you compute the KE, that is, you determine the expected rate of return by the shareholder or cost of equity for the company. One more small connectivity I'll show you over here, something important, follow up of the same thing. If I identify D1 by P0, it is the price that you are paying now to earn some dividend. That is nothing but the yield, right? We would call this particular term as dividend yield rate, and G stands for growth rate. So basically, the equity shareholders expected rate of return will be aggregate of two components. Which two components? the dividend yield rate and the growth rate. Now in this formula, KE equals to D1 by P0 plus G. If I shift this plus G to the other side what you will obtain is KE minus G, and one side now what you have is D1 by P0. If I cross multiply, I get the value of P0 as D1 divided by KE minus G. Again, you would have learnt at your intermediate level that this is what we call as the share valuation model given by Gordon. So you can call it as Gordon's model, which is also known as perpetual growth model. So quickly refer to this. I give you a moment's time, and once you recollect all these points that you have learnt at your intermediate level already, I'll take you ahead with calculative examples further. Let us solve some good questions back to back. So moving forward, about Gordon's model, if we talk further, P0 equals to D1 divided by KE minus G. We have discussed the meaning of all the variables. Let us talk a little more about this particular variable G. G stands for growth rate. And how can you compute growth rate under Gordon's model? How can you compute growth rate under Gordon's model? Three different ways. First of all, Gordon had an assumption that when the growth rate is constant, the growth rate applies to the growth in the share price, and at the same rate the dividends will also grow. So as per Gordon's model, there were certain assumptions taken to support that model, and one of the assumption was the rate at which the dividend grows must be matching with the rate at which the share price grows. So if share price is growing at 10%, it is assumed that dividends will also grow at 10%. So growth rate can be computed as P1 minus P0 divided by P0, that is growth in the share price. Growth rate can also be computed by taking D1 minus D0 divided by D0, that is the growth in dividends, and growth rate can be computed as B into R, that is product of B and R. Now what is B and what is R? B indicates the retention ratio and R is the return on equity. You know, there will be company's capacity to generate rate of return for its equity shareholders. That is what we call as return on equity, ROE. So don't get confused between R and KE. KE is the expected rate of return by the shareholder, and R is the rate of return that company can generate. So R indicates company's capacity to generate rate of return. KE indicates shareholders' expected rate of return. What is B in this formula? B is the retention ratio. Now what is the retention ratio? For example, if a company has a dividend policy of distributing 40% of its earnings in the form of dividend to equity shareholders, then say 40% is distributed as dividend to equity shareholders, the remaining portion of the earnings will be called as retained earnings by amount whatsoever it may be, but by ratio, by percentage, it will be 60% of your earnings. So if your dividend payout ratio is 40%, the retention ratio will be 60%. If dividend payout ratio is 20%, retention ratio will be 80%. So retention ratio is basically 1 minus dividend payout ratio. I'm sure these things also you would have learnt at your intermediate level. So the same concepts are applicable even at your final stage, and let me take you to some questions now. So question number 13 given in your sheet. It's a very good question highlighting a lot of important issues. By calculation, it will be extremely simple. Within a minute, you can get the answer without doubts. But it is not just about making calculations through formulas. It is about understanding the concept over here. Look at this question. NG Limited has been showing a consistent growth in the share price as well as dividend in the recent past. Such growth rate is about 10% per annum. Price of this share prevailing today is rupees 200 per share. the company is expected to declare a dividend of rupees 36 by end of the year. You are required to determine the expected rate of return for the shareholder at present. Now, as I said, even an intermediate student would answer this question within a minute, but my objective is not these calculations as of now, to connect a lot of important aspects. See, let us not bank upon any formula. Let us use simple common sense. As per this example, how much money do you think the investor would be investing now? The investor would be investing rupees 200 now. And what is the expectation of the investor? After 1 year, investor would receive rupees 36 as a dividend. Park that dividend one side. And the growth in the share price is 10%. So today's share price of 200 is expected to become 220. So what will be the wealth in the hands of the investor after 1 year? 220 as the future share price and 36 rupees in the form of cash which you would have received as dividend. So the total wealth in the hands of the investor by end of the year will be 220 plus 36. 220 plus 36 is what? 256. 256 is the wealth in the hands of the investor by end of the year. And the investor had to invest how much today? The investor had to invest just rupees 200 today. So by investing rupees 200 today, the wealth in the hands of the investor will be rupees 256. If 200 of today is becoming 256 in 1 year, you can logically compute the rate of return. 56 is your return by investing 200. 56 divided by 200 will give you 0.28 or 28%. This is the logical approach for making the calculation. If you can compare this with the formula that we have learnt, KE equals to D1 plus P1 divided by P0 minus 1. D1 in this example is what? 36. P1 in this example is 220. So D1 plus P1 in the numerator would give you 36 plus 220, that is 256. The denominator P0 is 200. So when you divide 256 by 200, what you will get is 1.28. 1.28 indicates that 1 rupee invested today will become 1.28 in 1 year's time, because simple logic is, if 200 of today is becoming 256, every 1 rupee invested today will become 1.28. From that you subtract 1 to find what is your return, because when you get back 1.28, 1 rupee is the repayment of your money that you invested, right? Your return is only that 0.28. 0.28 indicates 28%. Yet other way, if you simply use the formula D1 by P0 plus G, you will get the same answer. Look at this. Dividend that you are expecting in this example is what? 36. So D1 by P0, 36 divided by 200, that will give you 0.18 as your dividend yield rate, and growth rate already informed here is 10%. So 0.18 or 18% plus 0.10 or 10%, simple aggregate will give you 28%. That is how you compute KE using formula or using your simple common sense, the way you would want to calculate. As I told you, there is no scope of writing down the content over here. I have explained this whole thing to you. Quickly have a look at this and I'm sure you will understand it very easily. And I'll then show you the calculation even by using the formula. Alright friends, once you have understood this part, let me take you ahead and explain you through this calculation. K equals to D1 plus P1 divided by P0, and from the whole thing you subtract 1. If you are using formula, don't forget to define the variables. Defining variables is important, and when you define the variables, substitute the value of each variable and obtain the value of K, which will be 256 by 200 minus 1. And that will be 1.28 minus 1, that is 0.28 or 28%. Alternatively, if not this formula and you use the alternate version of formula, If you can recall, some time back we have learnt this formula got derived from the earlier one, right? So obvious thing is what? You will be getting the same values even through this formula. Substitute the values, I explained you already, you will be getting the same result, 28%. So I'm sure you have understood this entire example very well. Let us move ahead and take up the next example given in question number 14. Question 14 says a company had 1 lakh equity shares of rupees 10 each. The accumulated balance in reserves and surplus was rupees 70 lakhs. The expected rate of return on equity is 25%. The company follows a policy of retaining 40% of its earnings and distributing 60% as dividends. The same policy is expected to continue. The expected rate of return for equity shareholder is 25%. Determine the following: book value per share at present, expected EPS by year end, expected dividend per share by year end, that is D1, expected growth rate, that is G, and current value of share as per Gordon's model, that is P0. Now guys, if you are attempting this particular question, you should understand the meaning of what is book value per share. What is this book value per share? You need to understand. See, when the net worth, which is based on your balance sheet, I'm not talking about the intrinsic value. I'm not talking about the net worth that you will arrive at by considering the market value of the assets and the amount of liabilities expected to pay. I'm talking about picking the balance sheet values of all assets, subtracting all liabilities will give you net worth. When you divide the net worth attributable to equity shareholders by the number of equity shares, you will be getting the net worth per share. Once you get the net worth per share, apply this return on equity on that, and you will be getting what would be the expected earnings per share. And once you compute expected earnings per share, you know that you are going to distribute 60% of that as dividend. So you can compute the expected dividend as 60% of your expected EPS. So you can easily compute book value per share. How? Let me explain once again. Look at this. Company had 1 lakh equity share of 10 each. So share capital amount will be what? 10 lakhs. Reserves and surplus given as 70 lakhs. 10 lakhs plus 70 lakhs. 80 lakhs will be the total net worth attributable to equity shareholders. And there are 1 lakh equity shares. So obviously the net worth per share, which we can technically call as book value per share, will be 80 lakhs divided by 1 lakh, that is rupees 80 per share. And return on equity being 25%, the expected EPS will be 25% of the current net worth. 25% of 80 is what? 20. So expected EPS after the end of the year will be rupees 80. I'm sorry, it will be 25% of 80, that is rupees 20. And then the question is asking you expected dividend per share. Because the dividend payout ratio is 60%, your expected dividend by end of the year will be 60% of 20, and that is what? 12. Once you get that, you have to further compute the growth rate as well as the current value of the share as per Gordon's model. Let me now explain you how would you present the calculations in your answers. I discussed already the share capital amount is 10 lakhs, reserves and surplus is 70 lakhs. So net worth attributable to equity shareholders is 80 lakhs. Number of equity shares being 1 lakh shares. You find out the book value per share, which is nothing but the net worth expressed in terms of per share, and that you get as rupees 80 per share. I have explained you this already. Moving forward, the next calculation that was demanded, expected EPS. Simply compute expected EPS by multiplying the expected return on equity to the book value per share, that is 25% of rupees 80, that will be rupees 20 per share. So that being expected EPS, now it is easy to compute the expected dividend per share, that is D1. It will be simply expected EPS multiplied by dividend payout ratio, and that will be 60% of 20, and that will be rupees 12 per share. Now growth rate is not given in the question, and look at one thing, we have no information about what would be the expected price of the share by end of the year and all. We have only one way to arrive at the growth rate, and that will be the product of B into R. So growth rate will be G equals to B into R. You define what is B. B is the retention ratio. Because retention ratio is 40%, I have written that as 0.4. Return on equity is 25%, I have written that as 0.25. So G will be 0.4 into 0.25, that is 0.10 or 10%. Once we get 10%, all other components are known to us. P0 is D1 divided by KE minus G. So P0 value is dependent on D1 and KE and G, these three variables. D1 is already computed, it was 12. KE is given in the question as 25%, and growth rate we just computed as 10%. So let us substitute the values. 12 divided by 0.25 minus 0.10, and that will be 12 divided by 0.15. It would give you rupees 80 as the present value of the share as per Gordon's model. So quickly refer to this calculation, and then I take you ahead. Alright friends, once you have understood this whole calculation, let me take you ahead and take up question number 15 over here. Look at this question. A company has book value per share of rupees 137.8. This time book value per share is already given to you. Its return on equity is 15%. So this is return on equity, and follows a policy of retaining 60% of its annual earnings, implied that if 60% is retained, means 40% will be paid as dividend. If the opportunity cost of capital is 18%, what is the price of its share? Adopt the perpetual growth model. Perpetual growth model is just another name for Gordon's model. How do we apply these calculations? Simply, you identify that this is the book value per share and return on equity is 15%. So expected EPS will be 15% of 137.8. Then if the company is having retention of earnings as 60%, its dividend payout will be definitely 40%. So then compute 40% of the expected EPS, and that will be the expected dividend per share, that is D1. Thereafter, once you get D1 and you get the KE, KE is the expected rate of return or the opportunity cost of capital for the investor, which is given as 18%. So you know D1, you know KE. What is then left over? To identify the growth rate. Again the same thing, growth rate will be the product of B into R. Retention ratio is 60% and return on equity is 15%. You can easily compute the growth rate. So let us identify how to present the solution. Expected EPS by year end will be book value per share multiplied by return on equity, that is 137.80 into 15%, and that is 20.67. Retention ratio is 60%, so dividend payout ratio has to be 40%. Expected dividend by year end will be 40% of 20.67, that will be rupees 8.268. Growth rate will be return on equity multiplied by retention ratio, that will be 60% of 15, and that is 9%. P0 equals to D1 divided by K minus G. Now we have all the variables available in terms of their values. D1 is 8.268, K is 18%, and P0 is the value that you have to compute. D1 is known, K is known, growth rate we have computed. We just have to now substitute the values in the formula to compute the value of P0, which was demanded in the question, and the final answer comes to P0 equals to 91.867. So carefully look into all these calculations, and once you are clear with this, I'll definitely take you ahead. Alright friends, once you have understood this entire calculation, let me take you ahead to another very good question. Question number 16. It says a share of Tension Free Economy Limited is currently having cost of equity as 18%. When they say cost of equity means it is KE. KE is given as 18%. The current retained earnings per share being 37.5% is rupees 3 per share. If anticipated growth rate is 13% per annum, calculate the current price of the share. When you're handling a question like this, you have to be little careful because there are some missing information in the question and you should not make a mess with this. Lot of cautionary steps over here, and because I have been asking students to try out questions like this on their own, I generally notice what kind of mistakes they end up committing, and I'll tell you, you be cautious enough, don't commit such mistakes. First of all, focus on this line. The current retained earnings per share being 37.5% is rupees 3 per share. We are talking about current retained earnings. First of all, it is not the earnings which is expected, it is earnings which is for the current period, which is already retained. Now, this line indicates that the retention ratio is 37.5% and the amount of retained earnings per share is 3. So, if 3 is representing 37.5%, how much will be the remainder? Because if retention ratio is 37.5%, means out of 100% of earnings, 37.5% you have retained. So, the dividend that you would have paid will be 100 minus 37.5, that is 62.5% would be the dividend payout ratio. So the logic is, if 3 is representing 37.5%, how much will be the dividend per share that you have already paid? 62.5% will be how much? So if you pick your calculator, I would say 3 is 37.5%, so I divide it by 37.5 and multiply by 62.5. What I get exactly rupees 5. So if 37.5% of earnings is rupees 3 per share, 62.5% which you must have distributed as dividend would be rupees 5. Now, second point of caution, that this 5 is not your expected dividend. This is the current dividend. To arrive at expected dividend, which is D1, what you need to do is add growth rate to the current dividend to arrive at your expected dividend. Then you will get the expected dividend value, which is D1. The question is, what about growth rate? Growth rate we have yet to compute. So look at one thing. Cost of equity is 18%. Growth rate is 13%. This time they have given. So sometimes they may not give you the growth rate. Then you will have to consider return on equity multiplied by retention ratio. This time they have directly given the anticipated growth rate is 13%. So whatever dividend you got is the current dividend. The expected dividend will be 13% more than the current dividend. That will be D1. Growth rate is 13% and KE is already given in the question. You can solve it easily without any hassle. Let me show you how to present the solution over here. In your solution, you just write retained earnings, which is rupees 3 per share, is representing 37.5%. So dividend payout ratio has to be 62.5%. So if 3 is 37.5%, how much will be 62.5%? Using simple calculations, you can find out dividend per share is rupees 5. So EPS will be 5 plus 3, that is 8. Now this earning per share is not the expected earning per share. This is the current earnings per share for the year that has already ended. G stands for growth rate, which is 13%. D1 will be the expected dividend receivable by year end. So that will be 13% more than the current dividend, that is 5 plus 13%, 5.65. KE is the equity capitalization rate or expected rate of return by the equity shareholder, or you can also call it as cost of equity. Then you can apply the formula P0 equals to D1 divided by KE minus G, and when you apply these variables value, what you get is 113 as the value of P0. So carefully understand this whole thing. Take care of what kind of mistakes students generally commit and try not to have such mistakes at all. So I'm sure you people have understood this whole thing, and let me now take you to the next and last concept that is there in equity valuation. Now let us first read this question, then I'll tell you what is this concept all about. Dividend paid by X Limited in the current year is rupees 15. Equity capitalization rate is 20%. You are required to determine the present value of the equity if the dividend per share grows at 16% per annum for the first 2 years, 14% for the next 2 years, and thereafter 12% per annum. Now here there is a catch. See, the perpetual growth model propounded by Gordon, or simply Gordon's model, it was based on the assumption that the growth rate would remain constant, because you are applying the formula P0 equals to D1 divided by KE minus G. You can apply that formula only when the growth is constant. But here growth is not found to be constant. This is a case of supernormal growth. Correct? You will find in your study material they have given this concept under the heading supernormal growth. Why supernormal growth? See, initially when you start a business, the rate of return in that business initially will be very low, but then it will have rapid growth in coming few years. Once it reaches a point of sustainable growth rate, what we call as SGR, sustainable growth rate, thereafter the company can maintain that growth rate, which will be a minimal growth, but constantly it can maintain that growth rate. Say it is 6% or 8% every year. In this example, it is 12% every year after attaining that sustainability. But prior to that, your growth rate was little higher. That is why it is called supernormal growth. How to deal with this situation? You cannot apply Gordon's model formula until the growth rate has become stable. Growth rate has become stable only after 4 years. So you cannot find P0. You will be able to find the value of share only after the growth rate has become stable. You cannot find P0, you cannot find P1, you cannot find P2, you cannot find P3, but you can definitely find P4. Why you can find P4? Because after 4 years the growth rate has become stable. You know what formula you will apply now? P0 is D1 divided by KE minus G. We don't know P0, but we can definitely find P4. That is price after 4 years. But keep your mind alert over here. If P0 is dependent on D1, P4 will be dependent on D5. So P4 will be D5 divided by KE minus G. You will get the value of P4. That is one of the cash flow after 4 years. But before that, you will be getting dividend every year. Dividend for first year D1, dividend for second year D2, dividend for third year D3, dividend for fourth year D4. Your cash flows in future will be D1, D2, D3, D4 and then P4. All these will be future cash flows. Convert these future cash flows to their present value using your expected rate of return. You get the current value of the share, which is nothing but the present value of all the future cash flows. That present value of the share will be the value of the share that you have to report in this question as your final answer. That will be P0. So guys, when you are facing a question like this, keep in mind one thing: the Gordon's model formula, the perpetual growth formula, P0 equals to D1 divided by KE minus G, that cannot be applied when the growth rate is changing, when the growth rate is having variations. It can be applied only when the growth rate has become constant. So there is no problem if you are handling a question like this. You identify after how many years the growth rate has become constant. After 4 years, so don't compute P0, you compute P4, and P4 value will be dependent on D5. Now the question is how to arrive at D5? Very easy. Current dividend is given to you as D0. Look at this question's information. Dividend paid by estimated is not D1, it is D0. D0 means the current dividend already paid, that is 15. Now you have to compute D1, D2, D3, D4. Actually, your future cash flows will include 4 dividends, D1, D2, D3, D4, and then P4. But computation of P4 is dependent on the dividend of next year, that is D5. You will have to arrive at D1, D2, D3, D4, D5. Based on D5, then you will compute P4. How would you compute these D1, D2, D3, D4? Very simple. Each year's growth rate which is varying, they have given to you what will be that growth rate. So for example, in the first year the growth rate will be what? 16%. D0 is 15. So D1 will be 16% more than 15. So 15 plus 16% will give you D1. D2 will be D1 plus 16% because again in the second year the growth rate is 16%. But to compute D3, it will be D2 plus 14% because from third year the growth rate has become 14%. D4 will be D3 plus 14% and D5 will be D4 plus 12%, and thereafter the growth rate has become stable. That is why at that junction, at that point of time, you can apply Gordon's model formula, that is after 4 years the price that you compute is not P0 but it is P4. Let me now show you how to present the solution over here. Please carefully look at this. We will first compute D1, D2, D3 and D4. All these will be future cash flows which will be discounted to their present values. D1 you will receive after 1 year, so that is divided by 1 plus KE. D2 you will receive after 2 years, so it will be divided by 1 plus KE the whole square. D3 you will receive after 3 years, so it will be divided by 1 plus KE raised to 3. D4 you will receive after 4 years, so that will be divided by 1 plus KE raised to 4. And along with D4 you will now consider P4, and we will not have any problem in determining P4 because after 4 years the growth rate has become stable. So P4 can be computed easily, and to compute P4 you can apply Gordon's model formula at 4th year end, but mind it, it is still P4, it is the price at end of 4 years. To compute the present value you will have to divide it by 1 plus KE raised to 4. Then what you can do is separately find D1, D2, D3, D4 and P4 values. Let us see how to calculate that. D1, D2, so D1 and D2 were computed. D0, current dividend was 15, added 16% to that, 17.40 is the D1 value. On 17.40 again add 16% to get D2 value, which is 20.184. Then to compute D3, take 20.184, to that you add 14%, which is the applicable growth rate in the third year. What you get is 23.01 as D3. To compute D4, add 14% to D3, that is 14% added to 23.01 will give you 26.23, and then compute D5 by adding 12% growth to 26.23. Now if you are having a doubt that sir why did we compute D5, because in the equation over here we require only D1, D2, D3, D4. Mind it, D5 will be the base for computing P4. As I said, Gordon's model formula, which is P0 equals to D1 divided by KE minus G. The value of P0 would have been dependent on D1. The value of P4 will be dependent on D5. So P4 equals to D5 divided by KE minus G. Now you can comfortably apply this formula because now the growth rate has become stable. You can compute P4 value, and P4 value is 367.25. Once these calculations are done, Next task is simply to convert all these calculations to their respective present values, and you get what you want. I'm sure you have understood all these calculations. Let me take you to the later part of the solution. Year 1, 2, 3, 4 and again 4. The cash flows will be D1, D2, D3, D4 and P4. PV factors for each of these cash flows using 20% discounting rate, and then apply the present value factors to the respective cash flows. Take aggregate of all these present values and you will be getting the overall present value, which is P0. This is the final answer for this particular question. In your institute study material, this is given under the concept supernormal growth. So chapter 6 in your institute study material, which is bond valuation and equity valuation, we have just discussed that. What I am going to do today, as I said, at the later stage today, I am going to have the topic portfolio theory. It's little bigger topic. We will try to do as much as possible in today afternoon session. So the same link for this video continues. So you may join the same video after a break. So it's around 12:40 right now. The second session I'll be starting at 2 p.m. sharp. So be ready at 2 p.m. 2 p.m. to 5 p.m. or maybe 5:30 p.m. depending upon how long we take to discuss all what we want to discuss in portfolio. So mind it, those who are interested in attending the portfolio discussion should be joining me at 2 p.m. same video link. And tomorrow we are planning to cover derivatives and all matters relating to risk management in derivative market. And of course, the last day we have kept for the topic forex and foreign exchange risk management, international financial management, FDI, those concepts. And one more thing, there will be concepts which are interlinked between forex and derivative. We'll have discussion on those things also on the last day. So whoever is willing to attend whichever topic, just stay tuned with me accordingly. And in the comment section, you can always place request if you want me to cover any specific matter in the upcoming days. I'll do it for you. And do mention in the comment section as in what you would want me to do for you in the upcoming sessions, so that I can plan my sessions accordingly so that it benefits you the most. So fine, I'll be putting an end to this session right now. And okay, if you are willing that I should cover capital budgeting for you, so we will have to plan it out. So I therefore would want you to decide how you want me to take the sessions ahead. If you can list out which are the topics as per your priority, I can change the sequence according to that. I can exactly do as per your need, because I am not doing these revisionary sessions for my own benefit. It is for your benefit. So these revisionary sessions should benefit you the most, and that is why I am openly accepting each one's view as in what you need to do. And in case you have any specific requirement, you need to talk to me and discuss with me what you want me to do in the next session. Our office number is given. Our office number is given on our YouTube channel. You can find our office number easily. Communicate with us even before the lunch break gets over, and you can just put forward your request as in what you want me to do. I'll just do as you would want to. So with this note, I will be putting an end to this particular session. Don't forget, sharp at 2 p.m. we are starting the next session, and we will be starting with portfolio theory, portfolio management, and by that time you can convey messages or phone calls to us and put your request what topics you want me to cover ahead. Okay, so I'll see you sharp at 2 o'clock. Thank you very much.